So in a new public ruling from the SEC, this is pretty huge. They have confirmed that stablecoins are not securities. Now, remember, proof of work cryptocurrencies were labeled as not securities, which was a huge win. And now stablecoins are not being considered securities, which is just another huge win. Back-to-back decisions coming from the SEC. Stablecoins backed by cash or cash equivalent reserves and redeemable for US dollars on a one-to-one basis are not securities under federal law, the SEC said on April 4th, offering one of its clearest positions yet on regulatory treatment of crypto. In a public statement, the SEC's Division of Corporation Finance outlined its legal view on what it termed covered stablecoins, a category that includes fiat-backed digital tokens designed to maintain price stability through fully reserved dollar holdings. According to the division, the offer and sale of stablecoins do not involve security transactions and therefore do not require registration under the Securities Act of 1933 or the Securities Act of 1934. The move is likely to provide legal clarity for stablecoin issuers, fintech firms, and crypto payment providers that have long operated in regulatory uncertainty. Now, according to the SEC, covered stablecoins are designed and marketed solely as tools for payments, money transmission, and value storage. They do not grant holders interest, profits, governance rights, or ownership claims, and are typically described as digital dollars rather than investment procedures. Oh, you stupid pop-up. No. So the SEC emphasized that these tokens are not promoted as profit-generating instruments, a key distinction under federal securities law. The regulator's conclusion was based on two landmark legal standards, the Reeves versus Ernst & Young test and the Howey test. Under Reeves, the division found that covered stablecoins more closely resemble instruments used for routine commercial transactions rather than speculative notes or debt securities. The agency pointed to the buyer's non-investment motivation and lack of trading for profit as key reasons the tokens fall outside the securities definition. The SEC also applied the Howey test, which examines whether an arrangement involves investing money in a common enterprise with an expectation of profit from others' efforts. The agency found that covered stablecoin holders are not investing for returns and that the economic reality is that of a consumer transaction, not an investment contract. And just for fun, PiCoin fails that fucking test, so... According to the SEC, covered stablecoins must be redeemable for USD at a fixed price at any time and in unlimited quantities. Additionally, issuers must maintain a fully backed reserve consisting of cash or liquid, low-risk assets such as U.S. Treasury bills. These reserves must be segregated, not used for the issuer's business operations, and safeguarded from third-party claims. In some cases, issuers must also publish proof of reserve attestations to verify solvency and transparency. Obviously, that's something that's been needed to be done for a long time. While covered stablecoins may trade on secondary markets, their price is typically stabilized through arbitrage. If the market price rises above the peg, designated parties can mint new tokens and sell them for a profit, increasing supply and lowering the price. Meanwhile, if the price drops below the peg, they can buy tokens at a discount and redeem them for full value, decreasing supply and lifting the price. Now, this is a question about yields remain. These SEC highlighted that holders of covered stablecoins do not receive any form of yield or share in earnings generated from reserved assets. While issuers may earn interest on the assets held in reserve, those earnings are retained by the issuer and not distributed to token holders. Key difference when you're talking about things like PiCoin. It will be interesting to see regulatory clarity on proof of stake in particular. I think that's up in the air as it pertains to like Ethereum and node operators, etc. The commission emphasized that the absence of yield or financial benefit removes a key element of the Howey test, namely the expectation of profit derived from the efforts of others. By clarifying that covered stablecoins are not marketed as investments and offer no upside participation, the SEC drew a line between fiat-backed tokens used for utility and those marked with return-generating features. Need I tell you why or give you any example of what that might be? BitConnect. You got to be really careful with those things. The agency noted that tokens promising returns, profit sharing, or exposure to an issuer's financial performance could still be subject to securities laws. The statement does not extend to algorithmic or uncollateralized stablecoins, which remain subject to further legal and policy consideration. Nonetheless, the announcement marks a key milestone in delineating the regulatory boundaries of digital dollar equivalents. So there you go. Stablecoins are not considered a security. And coming off the back of proof of work not being considered a security, we have two big wins coming from the SEC as far as regulatory clarity. Unfortunately, it doesn't seem to be impacting the price of crypto positively by that much. I hope you enjoyed this clip from the Crypto Mining Show. If you would like to see more from this particular episode, take a look up here. Don't forget to also subscribe to the channel. And if you want to support me directly, you can go to sonofatech.locals.com and become a member. Thanks for watching, and I will see you next Tuesday.